Okay, Saria owned a business selling lady clothes. She maintained a system of double entry bookkeeping. The following occurred during the September 2022. Purchase of motor vehicle on credit for Sharper Motor. Ruhi, a credit customer, was declared bankrupt, owing 1,002. The debt is to be written off. That means we need to write off the debt, means irrecoverable debt in the question will come up. Prepare journal entry to record the above. Narrative are not required. Since that they say narrative are not required, means don't need to write the reason why you put through the journal. So we do the A section first, the journal. Okay. The first one, the number one is purchase of motor vehicle. Motor vehicle is a non-current asset and on credit from Sharper Motor. So the double entry will be debit motor vehicle and credit Sharper Motor. And the amount 6,350. Okay. The next entry, Ruhi, a credit customer, was declared bankrupt, owing Saria 1,200. The debt is to be written off. That means irrecoverable debt. Debit irrecoverable debt, and credit the person name, customer name, which is the Ruhi, which is 1,002. Since that they say narrative is not required, then we don't need to write down the reason. So that's for the section A. Now we go to the section B. Salia is preparing her financial statement for the year ended 30th September 2020. She provides the following information for the feature and fitting provision for depreciation. This is beginning of the year. During the year, the transaction sold feature and receive a check. The feature has been purchased on the 1st February 2018 for the 1500. Purchase new feature paying by check. Saria policy is to provide the depreciation on the feature and fitting at 10% using reducing balance method. So before we do it, since that they say depreciation method is reducing balance method. So start to think about the formula first. What is the formula? Cost minus provision for depreciation and then times the percentage. This is a general formula that we get. Or another is called net book value, because cost minus provision for depreciation is the net book value times the percentage in the question. So how are we going to know that? Because this question, you see, they got sold, got purchases. A full year depreciation is just in the year of purchase, but not in the year of disposal. So the question is that the feature has been purchased and they didn't tell us how many years that we got to calculate. So we had to calculate it first in order to find what is the total accumulated depreciation to be reversed from the provision to the disposal account. The disposal asset, disposal asset. We purchase date is on the 1st February 2018. And the cost that we purchase is 1,500. And when this financial year, 2019 October beginning year, so at the first year depreciation to calculate, okay? We calculate the first year depreciation for this asset first. First year depreciation, it starts from the 30th September 2018. This is the first year for this disposal asset. Okay, and the amount is 1,005 times how many percent? 10%. So we get 150. And second year depreciation is 30th September 2019. So the formula will be taking 1,005 minus 150, and then we times the 10%. So we get, let me count first. Okay, 1,500 minus 150 times 0.1. So 135. 135. Okay, this is the second year. And this second year, come to this financial year, this amount, these two accumulated amount. Total is 150 plus 135. So this total amount, we're going to become the opening balance, which is on the 1st October 2019. The provision amount, provision for depreciation amount, accumulated depreciation. It will be the 285. So this is for disposal asset. And the amount given in here, later on, we need to reverse out if the question asks to prepare the provision account. Okay, so basically this is how we calculate the depreciation. Okay, for the new asset purchase, basically is just straight away take 3,005 times this one. Okay, now we go to see got any question they ask about. Okay, they ask to prepare the feature and fitting based on the information given in the question. So let's open the T account first. Feature and fitting account. Date, detail. Okay, see what else the account they asked to prepare. Okay, they asked to prepare provision for depreciation and disposal. Okay, we one shot we ready it so that easier later. Provision for depreciation of feature and fitting, and then another one is a disposal account. Disposal of, okay, because this I want to move up easier for me to see. Yeah. So let me put it to share. Okay. The first entry we put is this one, 2019, October 1st, balance brought down. This is a cost amount 28,600. Another entry which is accumulated depreciation 6185. So cost is in the debit side. Provision for depreciation is in the credit side. And the amount is 6185. The second information, January 31st, sold, feature, and receive a check. So sold means that the feature as cost will have to reverse it out. 2020, January 31st. And this one go to the disposal account. All the asset related to the disposal go to disposal account. Same thing, this one credit, disposal account will be debit. So we debit disposal. Okay, debit disposal. Feature and fitting. The amount is 1,500. Okay, and then just now we have already calculated the total depreciation that disposal asset accumulated is 285. So we reverse from the provision account. So debit provision account, which is 285, and credit disposal account 285. So the double entry. Okay. Provision for depreciation. Okay, this is the amount. And now they say that sold, feature, and receive a check. They mean this 1150 debit bank must be debit bank because they say check. 115 debit bank, credit disposal. So here must be bank and amount 1150. So this is a double entry that we get. The next is that purchase new feature paying by check. The moment paying by check means that your bank account must be credit, and then feature and fitting account is debit. So in here we put 2020 March 31st bank 3,500. Okay. After that, no more other information related already. So basically we can close. And the question saying that close the account by balancing or by making appropriate year-end transfer. The year-end appropriate year-end transfer, they are talking about disposal account. You have to close it and transfer to the income statement. Okay, we do the cost first. So the year-end is September 30th. So balance carry down. Okay. Take the debit total minus the credit. So we get this one 30,000. Bring it to here, become October 1st balance brought down. So this is a double entry for the feature and fitting for the cost. For the depreciation, don't forget we have to calculate the year during the year September 30th. How much the income statement that we have to put in as a depreciation. I do it in beside here. Our cost beginning year. Okay, let's put in 1st October 19. The cost is 28,600. 28,600. This is the cost. Okay, and the provision for depreciation. In the beginning year is this amount. So the net book value, this is the net book value for the on net book value beginning of the year, which is 1st October. And during the year means that 30th September 20, we have a disposal. We need to take the cost. Our cost is 1,500. we already calculated the accumulated depreciation, which is 285. Take this one minus 1500 minus 285. So this is a disposal of the asset. We have to minus out first to get this amount. This is an existing old asset. This is an existing old asset in. And during the year, we have the purchase. The purchase, the new asset purchase, new purchases. The new purchases amount is 3,005. So we add these two together. So this amount, we need to calculate the depreciation. So the depreciation charge for the year, we're taking the 10% of it. So take this amount times 10%. So we, so this one times 10%. So we get 2,470. So we put into here. This amount is for this calculation to get the income statement amount. After that, balance carried down, balance brought down. So balance carried down. The subtotal, as usual, debit credit must be the same. Okay, take the credit minus the debit and bring it down to here. Become, okay, this one, how come? Okay. Balance what down? This amount, 8,370. So disposal account don't have balance carried down, balance brought down. The differences must transfer to the income statement as a gain or as a loss, depending which side is small. For example, here, this one credits, debit side is small. So in this case, my amount to balance off will be this one. Okay. So in this case, I had to take debit minus credit. So I get 65. This 65 is my losses actually. Income statement, transfer to the income statement. This is actually is a loss on this disposal. No carry, no brought down. So that is how we prepare the fixed as non-current asset and the disposal of the non-current asset. Okay, now let's move on. Okay, I try to be a bit slow. Saria considering forming a partnership with her friend Amy, who run the similar business. So the key thing that you have to be careful, what is the key thing in here? They say run the similar business. Actually, they are competitor. Amy and Saria is actually is competitor, but now they want to form partnership. Advise Saria whether or not she should form a partnership with Amy. Justify your answer with 2 advantage and 2 disadvantage. So advice means that give pro and con. They also emphasizing disadvantage, advantage. So what is the advantage forming the advantages of forming partnership? Number 1, okay, we have more capital. Because why? More capital, partner can contribute more compared to sole trader, because Saria now is a sole trader, 1 person. Other than that, if they are the same business, I mean they have the same knowledge, then it's also reduced. When they combine, reduce the competition, because they are the same business. They both run the same or similar business. When they combine also, it will share the knowledge, and skill. So what is the benefit to grow the business? Other than that, when you have a partner, so you have the workload can be shared. Workload share among both. So it's good thing that Sadia have more time to rest. That's a good thing about when you form a partnership. But disadvantages when we form a partnership, we are not so free compared to the sole trader. We can do what we want. So less freedom. So Saria has to get agreement from Amy to run from Amy how to run the businesses, run the business. Second is that if your partner do something not without your knowledge, you are bound to liable to it. Okay. Bear the responsibility of another partner for legal action related to business. So even though you are not agree, you still have to bear for it. Next is a not good is that the important is a profit has to be shared among partner. So your money get into pocket maybe have lesser really. So come back to this one. Advice means you have to give a final whether you agree or not agree. So what is your recommendation? If you choose to agree, then you try to talk something about it. If you choose disagree, then you talk about this one. For me, I feel I agree because since they are the similar business, then is to avoid the competition. Okay, it's good that they join it, then they can buy more and maybe they can get more discount. So for me, I agree they join it. So I would advise Saria to form a partnership with Annie because they are in similar business. This will reduce the competition in the market. At the same time, they can buy more goods to get better trade discount from supplier. They can share the workload to grow the business. So because I didn't check how many marks they given yet. Give me a minute. Okay, the question is only 5 marks. So basically, they want 2 advantage. You give 2 advantage, you get mark already. 2 advantage, you get mark. So basically, the recommendation only give you 1 mark. So you don't need to talk too long for the recommendation. It's more than enough already, this one. Okay, Enola compare her bank statement for July 2020 with the bank column of her cash flow. For this sentence, you can see that this is a bank reconciliation topic. She provided the following information. Overdrawn. Overdrawn means that you are owing money to the bank. Overdrawn balance show in the cash book. That means your cash book in the credit side. Direct debit payment dated 25th July have not been entered in the cash book. A check received from a customer on 12th July 2020 was dishonored. The dishonored check has not yet been recorded in the cash book. Next is that bank charge on the bank statement has not yet entered in the cash book. Unpresented check, uncredited amount. So they say that calculate the correct balance on the bank column in the cash book. Since they asked to calculate, you can use T account or you use the calculation. That means the statement format. So I use the statement format to present it. After that, I use the T account. Okay. Cash book. Okay, I put the header first. Corrected balance of the bank column in cash book at 31st July 2020. So start with the overdrawn. Overdrawn balance at 31st July 2020. So when is overdrawn? Okay, it should be in the bracket. Try to put into the bracket sign. Let me change it because the formula problem 323420. So this is the amount overdrawn. Okay, the credit side. And direct debit paid dated has not been entered into the payment. This is a payment direct debit. That means we should deduct. So when we deduct, this is a direct debit payment. Has not entered in the cash book. That means we have to minus. So minus, put a bracket. 350. Okay, next is that a check received from a customer on 12 was dishonored. This dishonored check has not yet recorded in the cash book. That means customer pay, after that realize cannot be used. So we have to pay, we have to reverse it out. So dishonor check. Dishonor check will reduce the bank balance. So also have to minus 665. The next one, bank charge on the bank statement has not yet entered. That means this is bank charge. Also have to reduce the bank in the cash book. So reduce 45. So basically these all amount are reducing. So in this case, this one the corrected balance will be taking negative 3420, okay, minus 350 minus 665 minus 45. So we get negative 4480. So here I put negative bracket 4480. So this is the amount that we get. Okay. If you want to make this one clear, then you also can put credit balance. Okay. If you don't want, also fine. So you have to put T account. So basically, these all are in the credit side, these 4 items. Okay, now next move on. Bank reconciliation statement. You already updated these 3 items. Left with these 2 that not done anything yet. Okay. They say that prepare bank reconciliation statement, clearly identify the bank statement balance at the date, because they didn't give the bank statement amount. So we have to rely on this amount that we get to prepare this bank reconciliation statement. So we prepare the bank reconciliation statement, bank reconciliation statement at 31st July 2020. We must start with this corrected balance. So updated cash book is 4480. We must start with the cash book because we got no choice. If we start with the cash book, then we have to add unpresented check, and then less uncredited deposit. So
got it. Oh.
Okay, I continue first. Add unpresented check, this amount 1290. Uncredited deposit minus 410. So our bank statement balance as per bank statement, it will be, let me count first, negative 4480 plus 1290 minus 410. So we get bracket 3600. And this 3600 in the bank statement is a debit balance. It's not a credit balance, debit balance. It's a difference compared with the cash book. If here credit, if a bracket credit, that means it's a credit balance. If here is a bracket, that means it's a debit balance. So that means we are owing money to the bank. That is for the bank reconciliation statement for this B section. Okay, now next, Iniala is concerned that her bank balance has decreased. Okay, let's see. Has decreased significantly during the last year. She is considering how to improve liquidity. Liquidity means that talking about the real cash in hand that you're going to have. Suggest one effect. Okay, suggest one effect of each of the following proposal, because it's only 1 mark, so you don't need to write too long lah, basically. Okay. Hire new non-current asset instead of purchase it. What is a good thing when we hire? For example, we should buy a car, but we don't want to buy a car, we go and rent a car. So in terms of the cash, buy a car, we have to give a lot of money out. But when we hire, we just maybe the car value maybe cost you 120,000. So if you don't want to buy, maybe you have to pay a down payment, some percentage of the car. But now you choose not to buy the car, so you just rent the car. The rent of the car maybe 1 month is 1,000. So you compare. You buy, you have to fork out certain percent of the car value. Then after that, you get to take installment, pay the bank loan, all this. But if you rent, you just take maybe 1 month, pay 1,000. 1 year is 12,000. So in terms of the liquidity, the money go out will be lesser. So here you can say the effect is, what I can say in this one, I say less cash outflow. for higher new non-current asset compare to purchase of non-current asset. So this one, liquidity should be better because in terms of the real money go out lesser. Okay. Now come to the number 2, delaying payment to credit supplier. It means you don't want to pay supplier so fast. Instead of supposed to pay within 30 days, you choose delay to 60 days. So what is a good thing? What is a bad thing? Good and bad happen to this one. Good thing for it is advantage. Advantage for it is that cash retained in the business can help to run the business for other purpose. But that thing, disadvantage, if you want to talk disadvantage, disadvantage is, I know this is not talk about this one, the effect. They want to talk effect, so we change it the effect first. Don't talk about advantage, disadvantage first. Okay, because they talk about the liquidity. So delay paying credit supplier will retain the cash into the business. So this will improve liquidity. So this is advantage, but this one could be the other impact on it. However, the supplier may stop supply. So this is a disadvantage, can be disadvantage, or if you want to add one more sentence also fine. But this, because it's 1 mark, don't need to give so many reasons. In Neola, financial year end is 31st July 2020. She provided the following information about the rent and rate. On the 1st August 2019, she owed 2 months rent total 900. On the same date, rate of 260 were prepaid up to 30th September. So this is transaction during the year. See what is the question they ask? They ask to prepare the T account for the rent and rate account. So you put in the information first. 2019 August 1st balance breakdown, which is the rate here 260. Okay, rent 900. Okay, now we move up to the question, so easier. Okay, so the beginning they given, okay, on first she owed 2 months rent total. So this is for the 2 months. 2 months rent, and then the rate were prepaid up to, that means this is up to the September. That means this is also 2 month prepaid. Because they say that up to 30th, the financial year, August start, August, September, this is also 2 months, this is also 2 months. Okay, now, during the year ended, so year ended 2020, August 1st, 7-month rent paid. So this is payment. Credit transfer, you must use bank. So you must write bank. August 1st, bank. And this one is pay for the rent. Please indicate behind the bank detail what you pay for, 3150. Okay, the next one is October. In October 1st, pay for the rate. Okay, this one is the rate 1860. Okay, this is that on the 2020 pay for the rent. Okay. So now we need to cover in terms of the prepaid amount. We know that this is an expenses account. This is a expenses account. So expenses account in the credit side, end of the year, you have to transfer to the income statement. So write income statement first. Income statement. You have two items that you pay. One is the rate. One is a rent. These two items. But we leave it first because we find the balance carried out easier. Okay, the balance carried out, whether it's rent or rate, we see the condition set here. We talk about the rate first. The rate have 2 month prepaid. And during the year, 12-month rate is paying. So total here 2 months, here another 12 months, total 14 months. So total 14 months that you have paid. So for the rate, total 14 months paid. That means you have 2 months prepaid. So prepayment is in the credit side. So here we put bracket rate to indicate this is referred to my rate. How to calculate it? Year 12, the whole year pay 1860 divided by 12. 2 months times 2. So this is the balance carried out amount for the rate. Now come to the rent. Rent have 2 months outstanding accrued. During the year, we pay 7 months. So 7 minus 2 months. So basically this is for the 2 months for last year. And then 5 months for current year. And then end of the year, pay another 6 months. Total 5 plus 6 is 11 months. So we have 1 month outstanding. So this amount will be sitting in here. July 31st, balance carried out. And this is the rent. 1 month only. How to calculate the 1 month? Taking this 2007 divided by 6 times 1. So we get 450. So this is the account that how we tackle the question. So now we have both done already. Balance carried out already completed. So the next thing is we calculate the subtotal first. Add the subtotal debit and credit first. Okay. Then this thing, because you have 2 types. So what we can do is we check for the rate. Rate 260. And then here rate again. And here got 1 rate in minus. So this is the for the amount for the rate. For the rent here 1, 2, and 3. Here got 1 minus. So we get 5,004. So 5,004 is for the rent. Rate is 1,810. So these two amounts that you are going to put into here. So you can sum it total because your this account is a combined account. So you get 1810. And then this one is 5400. So you transfer the total 1810 plus 5400. Transfer this total to the income statement. As usual, balance carry down, balance brought down must be complete. So 2020 and August 1st. Here is a balance brought down for the rate. Okay, whereas another side is a rent. 450 and then 310. So this is the account that we do for the prepayment and the other paper, other receivable topic. Okay, so this one done already. Now go to the E. Identify the section of the statement of financial position at 31st July 2020 in which each of the balance on the rent and rate account will appear. We see the information in here. Okay. If you look at these two amounts, rate is in the debit side, rent is in the credit side. That means here got debit balance, here got credit balance. Debit balance is an asset. So mean the rent, this rent is in the credit side. This will appear in the current liability because it's a liability in the statement of financial position. But for the rate is in the debit side. This will be under the current asset in the statement of financial position. Next is name one accounting principle Neola will apply when record the rent and rate. So basically in many topics that you learn, depreciation, other payable, other receivable, irrecoverable debt, provision for doubtful debt. There are two accounting principles always apply in many topics. One is the prudence. Another one is the matching concept. But because this one is talking about the year end, we adjusted this all and then we recognize this one. So in this case, for your I, you use the answer for matching. It's more suitable. Matching concept is talking about that expenses incurred match against to the revenue earned for the same period. So there is a matching concept rule. Now, state how Neola will apply accounting principle name in one. How? Look at the adjustment that we made. This is the answer that we need to say. Okay, you can say that adjusting the number 2. Expenses. Okay, I copy here. Since that this one I copy into here. Straight put into here. Okay, but I need to add some more, not finished yet. So this one don't need to explain since that second part they asked to say. Okay, expenses incurred match against to the revenue earned for the same period. The prepaid of the what? Prepaid of the rate and accrued of rent adjusted into the account. So there is the answer that we can use. Okay, so that is for the second question about the, here you notice that the past year question, when you do the past year question, they combine a lot of small topics. For example, the first part, they talk about the bank reconciliation topic. And then second part, they start to talk about the other payable, other receivable topic. So this is a combination of the topic, of the topic. When you saw not maintain full accounting record, this one most probably is incomplete record topic already. So you need to see, could be what is, because incomplete record, maybe they ask you to prepare the statement of affairs. Maybe they'll just give you some information, ask you to prepare income statement or statement of financial position to complete the income statement. So let's see, we are information given first. Haziz has not maintained full accounting record for his business. Haziz provide the following information for the year ended 31st July. Beginning year, end year. This one got asset, got liability. So you need to decide which one is asset, which one is liability. And summary of the bank account, debit and credit. And the gross profit margin 40. All sales were called for cash. All cash received were bank. That means basically you sell cash on it, but all the cash money that you receive from the sale immediately put into the bank. It means that this sales receipt is the total revenue. Okay, they asked to prepare the income statement. So let's prepare income statement for the year ended 31st July 2020. Okay, I put it into here so that easier to prepare. Okay, four section, revenue. You put section first, revenue less cost of sales. The format, we put the format in. After that, we have the gross profit. If you have any other income, we put in. We don't know whether got or not, haven't checked the question. Less expenses. But in the exam, you've got no time to do this all. You straight away split to understood in your mind. This all the section must be there because this one, it will take your time to do it. Profit for the year. Okay. First of all, the question saying already all sales were for cash and all cash received was bank. Even this total amount 166 is your total revenue 166. Don't need to talk about it because they given the information. They try to give hint to us. This is the total revenue. So we just take this one as a total amount. Okay. In terms of the the cost of sales. Cost of sales, we have opening, okay, opening inventory, which is the inventory at 1st August 2019. Okay, purchases they didn't mention, but we can see from the information. Okay, normally item inventory, purchases, and then closing inventory at 31st, beginning year, end year concept. Okay, other than that, okay, let's see what else the information. Inventory beginning year is 8,004, but end year they put question mark, means they want us to find ourselves. Come to the purchases, we do not have the information. How we going to tackle it? We saw the trade receivable. We saw the payment to the credit supplier. So using this information, we find our purchases. So total payment to the supplier is 96,220. Plus the year end. Year end still accrued 746 still owing us. And beginning year, this is for the last year. So we minus 6280. If you talk about the T account, I put in the simple T account here. Put in the simple T account here. Okay. Actually use the trade payable concept to find it. Beginning year balance brought down. We have the amount of how much show it? This one. Beginning year is 6280. End year, during the year we pay. Pay means that the bank amount is in here. Okay, bank amount given payment to the credit supplier is 96,220, which is this amount payment to supplier. Okay, next is that balance carried out. Where we get the balance carried out, because this is a liability, so debit side. So this amount 7460. Take these two plus, and then so we can find the purchases. Take this minus this. So this is our purchases. If you are using the T account concept, but because in the exam we need to show the detail how we get the number beside the detail. So it's good put beside here. Okay, show the 96220 plus 7460 minus 6280. We find the answer for this one. Okay, you can use this method, but it's put in the detail how you get the answer for it. Come to here, we don't know. They put question mark. So how are we going to find it? If you see the information given into this question, the gross profit margin was 40%. Okay, I add the percentage. They say that gross profit 40%. Gross profit 40% means that revenue is 100%. In this case, here is a less. Cost of sales will be 60%. 100 minus 40 gets 60. Yeah? So this is how we get it from. So using this one pair of the information, this is consider one pair. You can find these two numbers because the question asks us to prepare the income statement. So you have to have the gross profit, cost of sales amount. So we take this amount, divide by 100% to get 1%. After that, times 60%. So this is our cost of sales. Cost of sales, we got it already. Then we can take revenue minus cost of sales. And how to find this one? So let me put in somewhere here. Okay, cost of sales is equal to opening inventory plus purchases minus closing inventory. And inventory is the answer that we need to find. So we change the position, closing inventory equal to opening inventory plus purchases minus cost of sales. Negative, move it to here, become positive. Positive, move it to here, become negative. That's how we change the formula. So in this case, we take the opening inventory plus purchases minus cost of sales. So we get our closing inventory 6,200. So settle for this one already. The gross profit, cost of sales information, revenue, all done. Okay, what else the information that we need to take in? Okay, we need to see whether got other income or not. For this question, I don't think they have other income. Okay, let me check. Okay, don't have other income. So in this case, don't have other income, we can take out this one. Okay, don't need to take this. Straight away, minus the expenses. What are our expenses that we have in the question? Let's see first. You saw the rent. You saw the net book value, net current asset at net book value. That means this is about depreciation. So rent, wages. So three things that we see. So depreciation come in. Depreciation. Depreciation of non-current asset. Okay, and then after that, let me clean up. Else the rent account, wages account. See any more item? Okay, bank loan interest. Interest, bank loan interest. Okay, any more? General expenses. Expenses. So these few items. So how are we going to calculate depreciation? So first of all, here don't have the purchase of the non-current asset. Only these two. This is called revaluation method. They are using revaluation method for the calculation. Revaluation method for the depreciation. So take the opening minus the closing. So you will get this one. So I put into here so that you can refer in future. Minus 32450. So this is the information that you can take. Okay, now next is that how come I short of number? 33580 minus 32450. Okay, this one should be the correct one. Okay, now next mode, rent. Rent beginning have the prepaid. End of the year also got the payment amount. So in this case, we have to take rent pay amount 624 plus the prepaid beginning. Beginning year prepaid have to plus, not minus. Prepaid beginning have to plus. So 2640 plus 240. So this is a rent. And then after that, the wages. Wages pay is 41,400 plus accrued year end. Year end accrued had to plus because we haven't paid. We are owing. It's a expenses incurred. So we take plus 610. So end year expenses had to plus. Beginning year expenses also had to plus. Next, bank loan. Bank loan is we don't have, let's see, bank loan interest 300. Okay, general expenses we have 10890. So that's all. No more. I think no more any adjustment already. Okay, let's we add the subtotal. Okay. Okay, let's see the total add up first. Let me add the subtotal first. Okay, 59. Okay, let me see got any mistake miss out or not. Depreciation. Okay. One more thing. Because of the new format, I've forgotten already. New format for the income statement, take note, sorry. This is the old format. The new format in the 2020 syllabus. Take notes the bank loan interest. This bank loan interest. Don't put together with the expenses. This is a new format. Old format is everything dumped into there. Can already. Now the new syllabus, the 2020 syllabus, they want us to split the profit from operation and the profit for the year. They want us to split these two items. This one is a finance cost. We have to separate it up from the expenses. Do separately for the deduction. Show separate line after the profit from the operation. That is what I've forgotten to do it. Okay. So take note the differences for the before 2000 and 2000 syllabus, 2020 syllabus. This line, this is the finance cost. Finance cost had finance cost had to deduct from profit from operation. So there is a thing that you have to we got to take notes. So the final profit for the year is 7190. Okay. Okay, now we continue the next section. Okay, be advised Hasis whether or not he should maintain a double entry bookkeeping system for his business. Justify your answer with the 2 advantage and 2 disadvantage. What is the benefit, advantages of double entry bookkeeping? First, we have all the recording in hand. All recording or transaction are ready. It is easy for us to prepare financial statement. There is the advantage of it. And other than that, when we have the financial statement ready, people will trust us. The account is more reliable and accurate. So what is the benefit? The account submission should be less query. That means your government will not ask you how much the actual tax you have to pay. There's the advantage. Other than that, what else that benefit we can get? Reduce the frauds. Why we can reduce the fraud? The transaction can be reconciled. Reconcile means check lah. Reconcile or check. Okay, there's advantages of a bookkeeping. Disadvantages, since the question one, disadvantages. Disadvantages of it is, if you want to do the double entry bookkeeping, you mean you have to hire a person know how to prepare the account. Hire a staff to handle the account. What will happen? Cost increase. Operation cost increase. Operation cost increase. Then your profit decrease. So that is what we can say. The hiring cost the increase of the. Okay. Other than that, if you are the one can do the account, know how to prepare the account, basically you can do it yourself. But the problem that, do you have so much time or not? So because it's a time consuming to prepare the double entry system. So there is disadvantage. You don't have the time to prepare on it. Okay, so these two are advantage, disadvantage, but now come to the advice. Advice means that you want to give recommendation. You notice that all now the question all ask you advantage, disadvantage. After that, one more mark. So also same thing, 5 mark. Give me 2 point here, 2 point here, and then 1 mark for the recommendation. Logically, we should support. Okay. I would advise Aziz to maintain a double entry bookkeeping system to avoid unnecessary query from inland revenue. What we most scared when we do the account is that income tax come and check the account. We don't know how to answer them. When you prepare all the account properly, easier for you to trace back the recording. So that I would advise Aziz to maintain a double entry bookkeeping system to avoid unnecessary query from the inland revenue. It is also help him to check if got any doubt of the transaction. So there is a benefit that we can get when we prepare the double entry bookkeeping concept. Okay, so here 3 questions we done. Notice that all the last one asked for the theory question are advantage, disadvantage, pro and con, and then recommendation. So that is for the 3rd question that we are preparing now. Okay, we continue with the question number 4 for the past year question, and this is from paper 21 October-November 2020. The director of DW Limited provide the following information at 30th September 2020. So this is all the detail that we have. We have 6% debenture, so payable on 2028. That means this is a non-current liability. Bank overdraft is a current liability. Dividend pay, general reserve beginning of the year. Inventory at the end of the year. Issue share capital beginning of the year. Non-current asset end of the year. Cost and provision for depreciation, other payable, other receivable. Provision for doubtful debt at 1st October 2019. This is beginning of the year. Okay, additional information, a draft income statement for the year ended 30th September 2020 was prepared showing a profit of 84,900. The following error later discovered. Inventory of 36,300 include the item value at cost 5,200 that need repair. After repair costing 600, the item could be sold for 5,000. So first of all, number 1, information is related to valuation of inventory. The information given to us is that they say that the cost is 5,200. And at the same time, after repair cost, the item can be sold. So this is a net realizable value. So the net realizable value is, take the 5,000 minus 600. So this is the value that we get for our inventory, 4,004. Valuation of inventory saying that inventory value at lower of cost and net realizable realizable value. So in this case, cost is higher than the net realizable value. We have to take the net realizable value for the closing inventory. So in this case, our closing inventory in here, this amount, inventory at 30th September 2020, we have to adjust it. Okay, how are we going to adjust it? We take the okay, let me clean up first. I put into here. So closing inventory will be 26,300 minus 5,200 plus 4,004, because this is the amount that we should recognize. So let me calculate the amount first. 26300 minus 5200 plus 440. So 25,500. So this is the amount that we get. Number 2 information. Operating expenses include insurance that was prepaid at 30th September 2020. So in this case, prepaid amount, we have to adjust it. Operating expenses. This is to recognize in the income statement as expenses. So we have to adjust. Prepaid end of the year, we have to minus. So operating expenses, where is operating expenses? Okay, they don't give it to here. So in this case, most probably they didn't ask for the income statement. Okay, so this one, no, just to highlight lah, had to deduct from trial balance. But another account, other operating expenses, we are going to recognize it in the statement of financial position under other receivable, which is that the asset that we have, the 400. So this amount had to recognize as a other receivable. Okay, number 3. The provision for doubtful debt show has been adjusted so that it's equal to 5% trade receivable. So in this case, we want to calculate provision for doubtful debt, the balance carried out amount. So we have to take the trade receivable, which is 14,500. 14,500 times the 5%. Okay, so we get the amount is, let's calculate first, 14500 times 5 divided by 100, 725. 725. So this is the amount for the balance carried out for the provision for doubtful debt. The director decided to transfer 5,000 to the general reserve. So this number 4 information, transfer to general reserve. So the double entry will be debit retained earning and credit general reserve. There was no change to the issue share capital during the year ended 30th September. So that means no share change. We don't need to worry about it. Now here the question, calculate the correct value of the inventory at 30th September. Okay, this is the amount that we should take into it. Okay, so valuation of inventory is inventory value at the lower of cost and net realizable value the cost is 5,002. Net realizable value is 4,400. So the closing inventory, okay, we change it to inventory since they are using the date. So we change the date. Inventory at 30th September 2020 is 25,500. So this is the amount for the closing inventory. Okay, now next, calculate the revised profit for the year ended 30th September after adjusting the error. Okay, we have to do the revised profit for the year ended 30th September 2020. Okay, so this one is a profit before adjustment. So how much the before adjustment? Okay, let's see the question. Okay, here they said a draft income statement for the year ended was prepared and showing a profit of the, so this is a profit before adjustment, 84,900, 84,900. And the three items in here, closing inventory, we have lesser value compared to the initial amount. So the differences, which is the, take the 5200 minus 440. So this one, closing inventory reduced. Okay, I just highlight somewhere here. Closing inventory reduce, cost of sales increase. When cost of sales increase, gross profit decrease, and then profit decrease. So this is the impact on the closing inventory. So in this case, we have to minus, okay, we have to inventory decrease, we put decrease in closing inventory. Okay, the amount is we take 5200 minus 4400. So 800, the amount decreased for the closing inventory. And next is that, so if can, to avoid that, after that you forgot to have to minus, we can put the bracket 800. Okay. So now next is that number 2 error. Operating expenses, we forgot to do the minus from the expenses account. So now we minus the expenses. Decrease in operating expenses. When is a expenses decrease, profit increase. Okay. So this is the amount. Increase, we have to put in the plus 400, and then provision for doubtful debt 7200. So this one 720 compare with the opening. So where is the 625? So this is opening, this is a closing. Okay. Increase in provision for doubtful debt. When expenses increase, provision for doubtful debt provision for doubtful debt increase, expenses increase. So expenses increase, profit decrease. So this is an implication of the change. Okay, so this one will cause the profit reduced. Okay, reduced by how much? End year is 720, beginning year is 625. So 725 minus 625, the differences is 100. So the amount will reduce by 100. So now the revised profit, we take 84900, the beginning year, the profit before adjustment, minus 800 plus 400 minus 100. So the new profit will be 84,400. So there is a revised profit for the year. Let's move on. The next, they asked to prepare the statement of change in equity. This is the format that I would like to share. This column is a share capital, retained earning, general reserve. You can swap these two positions, same, no problem. Starting beginning year, profit for the year, dividend paid, only dividend paid will be recognized in the statement of change equity. So take note that only dividend paid will be recognized in the retained earning. If a proposed dividend, no accounting entry. Transfer from general reserve, that means retained earning received, then general reserve giving out. If transfer to general reserve, retained earning giving out, general reserve receive. New share capital, but because this question don't have the new share, so basically it's quite straightforward. Okay, let's prepare the statement of change equity. BW Limited statement of change in equity for the year ended 30th September 2020. Share capital and then general reserve, retained earning, and then total. Okay, start from the on 1st October 2019. So what is the amount in the beginning year? Go to the trial balance and look into it. The share capital, let's see where is the share capital. Issue share capital at 1st October. This is a 200,000. Okay. And then general reserve. General reserve beginning year is 6,500. And retained earning. Okay, retained earning is you don't have the retained earning. Where is it? Let me double check. Okay, then I didn't see where is the retained earning. Let me check one more time. Here, don't have. Yeah, here, in here, retained earning, 73,475. Okay, subtotal. Okay, see the transaction related to the statement of change equity. Now, here we have dividend paid, 2,000. So we put in dividend paid, dividend paid. And dividend pay only affect the retained earning, which is 2,000. So 2,000. So bracket, I put in bracket because I want to indicate this is have to minus. Okay, what else that transaction related? Okay, the profit that we have calculated. The profit for the year, which is this one, huh? Okay, profit for the year. Profit for the year. Profit for the year is under the retained earning. Okay, what else the information related? Let's see. Okay, they say that the director decided to transfer 5,000 to general reserve. So this double entry, we had to make adjustment, the 5,000. So this one, transfer to general reserve, 5,000. So 5,000 receive money, and then retain earning, giving out the money. Okay, now next is any more entry related. There was no issue. There means no share capital new issue. So no need to calculate. So basically this is the item that we have only. Okay, now we can calculate the subtotal. Okay. So this one will be this minus 2,000 plus the year profit minus 5,000. So we have the closing retained earning 150, and then general reserve and capital. So this is on 30th September 2020. So just subtotal it because I'm putting the sign, so that's why I can't use a formula. So here, this one is this amount. This one basically is 0. And the subtotal for it should be the same. Column and the horizontal calculation should be the same for the subtotal. Okay, next is that, okay, they asked to prepare the statement of financial position. So let's go through some notes before we do the exercise. So this is the notes for the statement of financial position. We have the non-current asset, 3 column, current asset, and then total asset. Next is the equity and liability, which is we have capital and reserve, share capital, general reserve, retained earning. Non-current liability normally refer to debenture or bank loan. Current liability, trade payable, other payable, bank overdraft. So this is common item that we have. So now we go to the question. Okay, we need to prepare the statement of financial position. Start with the non-current asset. A non-current asset, we must have 3 columns: cost, accumulated, depreciation, net book value, let's see, just highlight it. Okay, what are the non-current assets in this question that we have? Let's check. Okay, they didn't give many details. They just give the total cost and the provision. So we straight away adjust it, the presentation, since that there is no detail of the non-current asset. This non-current asset straight away put into here. Don't need to underline because this become one of the account. So the cost amount is 46200, and then accumulated depreciation. Accumulated depreciation is 10600. Okay, so take cost minus. Next is the current asset. So let's see what are the current asset that we have in the question. Okay. Okay, we have the inventory because just now we calculated. And then after that, we have trade receivable. And don't forget this trade receivable. The question have the provision for doubtful debt. Provision for doubtful debt is always provision for doubtful debt, always together with the trade receivable. Other receivable. Okay. Now let's recalculate. Inventory, we have the net amount. What is the net amount? This is the net amount, 25500. And the trade receivable amount is 14500. Based on just now the calculation of the provision for doubtful debt is 725. So we have to take trade receivable minus the provision for doubtful debt to get the net of the trade receivable. And our this other receivable refer to the insurance prepaid that we made just now. Okay, and the amount is, let's see, 400. Okay, 400. Okay, next is, let's see, got any more other related. Okay. Let me see what else the information here. Okay, here got one other receivable, 1006. So in this case, we got to do adjustment. So in here, we have to plus 1006. And this one, you don't show the insurance, you will put in original amount plus 400. Show the working how you get the total. Okay, now let's move on. Can we add the total first? You take the current and non-current plus together. So we get 397,275. Another one section, another section will be equity and liability. So what is our equity section that we have for this question? Equity. We have share capital, the questions share capital, and then general reserve, where this amount can be obtained. We can go to the, because the question asks us to prepare the statement of change equity. This amount, these three amount, we can use it to put into the equity section. We don't need to calculate, we just add the amount individual, show the individual amount. Okay, share capital, general reserve, and then retained earning. Okay, add the total. Next is that non-current liability. Let's see which one is a non-current liability. Non-current liability is the liability more than a year to repay the amount. So here you saw the 6% debenture, 2020. So this 6% we don't need to calculate the percentage, because they are not asking you to calculate the income statement. 6% debenture. We just write like this one, because it's only one item. So basically we straight away put it to the second column. So this amount is 18,000. Okay, now next is that current liability. Let's see what are the current liability that we have in this question. Okay, here bank overdraft. Bank overdraft. And then what else that we have? Other payable. Other payable. Other payable. After that, what else? Still got any more? Okay, trade payable. Three items that we have for this question. Trade payable. So let's we put in the amount 6450. Other payable is 2200. And then trade payable is 8250. Okay, let's we add up the total, see whether can balance or not. If the amount can balance, then our account should be correct. If cannot balance, then we got to check. So take the equity plus non-current plus current. So we get the, so you notice that these two amounts are the same. So when it's same, that means our account should be correct. Okay, that's all for the question number 4. Okay, question number 5. Nazim owns a wholesale business and has prepared draft financial statement for the year ended 30th June 2020, his first year of trading. When they say first year, they basically don't have opening. After preparing this financial statement, some error were discovered. Number 8, the question saying that complete the table to indicate the effect of each error on the profit for the year and the working capital. This question A, the section A is to take note is that error effect on profit or working capital. Sometime in the exam, they could also ask after correcting the error, what is the effect on profit and working capital? But this question, this is not the one is the error before adjustment. What is the impact on the profit and also working capital? Right, understated, overstated, or no effect. The first one example they given to us. Here, repair to office equipment has been entered in the office equipment account. So I will just put in the implication. So what happened is that repair account understated. There is the account that expenses understated. When expenses is understated, profit will overstated. There is an implication from the let me adjust the file first. Okay, profit overstated. Okay, let me arrange the file first. Okay, let me repeat again. Repair is the expenses account. When repair is understated, expenses understated, profit will be overstated. Okay. Why working capital no effect? Because when we wrongly debited into office equipment account. This account is a non-current asset section. So now working capital is only affecting when give impact is when there is a change in the current asset and the current liability. So since that this is go through the non-current asset, so therefore there is no impact on it, no effect. Number two, adjustment. Number two error, no adjustment has been made for the insurance prepaid. Insurance prepaid. Okay, should deduct from expenses. So now what happened is we didn't adjust. It will cause the expenses overstated. So when expenses overstated, profit understated. So there is an implication of the account when we forgot to adjust the prepaid. So profit will be understated. Next is that the insurance prepaid should be recognized as other receivable in current asset. So now we didn't recognize because we didn't adjust. So current asset understated. When current asset understated, working capital also understated. So therefore, this answer, profit understated, working capital understated. So here, understated, understated. So there is an impact. Next is that an irrecoverable debt not been written off. Irrecoverable debt is expenses. Recoverable debt is expenses. So expenses forgot to do. That means expenses will be understated. When expenses understated, profit will be overstated because profit is linked direct from the expenses. Next is that when irrecoverable debt is not written off, debt not written off, trade receivable overstated. Trade receivable is under current asset. So current asset also will be overstated. So when current asset overstated, working capital overstated because of the formula, working capital formula, working capital is current asset minus current liability. So there is the impact of the transaction. So here, profit will be overstated. Working capital also overstated. So here will be overstated. Okay, now next, no record has been made of the additional capital introduced in cash. So the double entry for additional capital is a debit, cash, credit, capital. So these two account is under the statement of financial position. Cash account and the capital account is under the statement of financial position. So therefore, profit no effect. So in this case, profit no effect, but the working capital, when we did not debit cash account, what will happen for the cash? Then we will have the lesser or cash understated. When cash is understated, current asset understated. Current asset understated, working capital will be understated as well. So this is the implication of the account. So here, profit no effect, working capital understated. So this one no effect, this one understated. Okay, next, closing inventory has been overstated. Okay, closing inventory overstated, cost of sales understated. Cost of sales understated, gross profit overstated. Gross profit overstated, profit will be overstated. There's a link of the closing inventory. When closing inventory overstated means that extra. Overstated, current asset will also overstated. When current asset overstated, working capital also overstated. So there is an implication for the error. Okay, so this will be overstate. So there is an answer for this question, and the impact and the link of the error that I highlighted in here. This will help you to understand more about the implication. Okay, now let's move on to the next question, next section. After correcting the error, Nazim compared his result with those of his brother Aziz, who has similar business. So Nazim and Aziz, current ratio, basically Aziz is better because this one is 2.12, higher is better. Liquidity, same thing, Aziz is better than Nazim. Return on capital employed, Aziz is also better. Suggest two reasons for the difference in the current ratio. Why that current ratio for both are different? So the formula, just talk about formula first for current ratio. Current ratio. Okay, the formula is a current asset to current liability. Okay. This one higher means that Aziz has more current asset than the current liability. That's why Aziz can have more. You notice that this amount is 2. Then basically Aziz has 2 times ability to pay off the debt. So number 1, we can say Aziz has higher amount of current asset compared to Nazim. Okay. Other than that is number 2. Maybe Aziz has more or has less liability, which is the current liability. So Aziz has lesser amount of current liability compared to Nazim. If you don't want to talk about Aziz, you can talk about Nazim, but just change the word from, example, in here, you want to change Nazim. Nazim has a lesser amount of the current asset. And then here, you can say Nazim has a more amount of the current liability. That also can be done. Okay, now let's move on. Okay, liquidity. Liquid asset or acid test ratio. Acid test ratio formula basically is we take current asset minus inventory to current. What's wrong? Give me a minute, something wrong. Okay, let me one more time. Okay, current asset minus current liability to current liability. Okay, so current asset minus inventory. It basically means that liquid asset does not include the inventory. Okay, same thing, number one. What we can talk about it. Let's see what is the better information that we have. Because this one, Aziz is better. Aziz has more cash compared to Nazim because he still have the highest compared to Nazim. Okay, next is that they want to answer for it. So we put two reasons for this one. Next is that you can say Aziz keep lesser inventory, but other current asset more. Okay, or else you can talk about Nazis. Nazis has what? Nazim. Let me see what's the information can put. Nazim, okay. Nazim may hold too much inventory cause the cash or liquid asset less than current liability, because you notice that after exclude the inventory, Nazim is hold less than 0.77 the current asset. Basically, he hold quite a lot of the inventory, cause that the liquid asset less than current liability. Number three, ROCE. ROCE is talking about the, put formula first. ROCE is taking the profit, okay, profit before profit from operation divide by the capital plus non-current liability and then times 100%, which is capital, another word we call capital employed for the capital plus non-current liability. So profit from operation is the profit before interest charge, or so-called, sometimes we call finance cost. So this one had to take notes. The new syllabus emphasize profit from operation and the profit for the year. Okay. Now, this ROC, what is the purpose of ROCE analysis? It will help us to find how much profit earned from each $100 invested into business. So that is what we can indicate as well. And then it's also show that the efficiency of the business use the asset or resources to generate income. There is an ROCE meaning. So come back to this one. ROCE, which one is better? Same thing. ASIS is better. So in this case, the ROCE can be better. Most probably ASIS has higher profit from operation compared to Nazim. And then other than that, talk about the capital employed and the capital, the proportion, the increase of what we can see, the increase of profit, the increase, the capital employed held by Azim is lesser proportion compared to Nazim. So there is capital employed lesser, profit will be less. Okay, now let's move on. Another, you can say that Aziz is using his use his resources more efficient compared to Nazim. This is all the answer can be used. Okay, now let's move on. Nazim discovered that his rate of inventory turnover was also lower than the Aziz. So what is the inventory turnover? Inventory turnover, the formula is taking the cost of sales divided by the average inventory, and the answer we will get in a time. How many times that you use your stock to generate the sales. So in order to get the inventory turnover higher, what we got to do is we must have the cost related to cost of sales, which is the sales activity. Sales activity is better or higher, okay, to sell the inventory. Okay, another one is sales activity is higher to sell the inventory and generate income. Okay, that is one of the higher if we want. Another if we want to have inventory turnover higher, we have to have holding lower of inventory level. Means that you buy and sell when you need, only you buy and sell. So that is will reduce the holding level. Then it will cost the inventory higher. Because basically for this the question, you need to take note one thing is that using the formula base, the formula base is in here. Inventory turnover is cost of sales divided by the average inventory. So in order to get this one higher, because they say that Aziz is higher and Nazim is lower. If you want to get it higher, this one must be higher. But this higher is related to the sales activity. Okay. Another is inventory. This is using the mathematical concept. When this one increase, this one must decrease. So that can increase the inventory turnover. So there is a message to send out is that use the formula to indicate whether you want to higher inventory turnover, increase the sales activity, which is this one cost of sales will increase, and the average inventory had to reduce. The holding level of the inventory had to reduce. Okay, let's move on. Okay, Nazim is concerned about the length of time his credit customer take to pay their account. He is considering operating a strict credit control policy. Required customer to pay within 30 days. 30 days is quite common in the business. Advise Nazim whether or not he should introduce this strict credit policy. Justify your answer by providing 2 advantages and 2 disadvantages. So as usual, when the question asks you to advise and ask to indicate 2 advantages and 2 disadvantages, you summarize with the notes first. Let's see, we put in what are the advantages when we have a strict credit control. The risk of irrecoverable debt reduced. That is one of the good things. Second is that the thing, if you have the strict, then your cash flow will improve because you get money faster, money in faster. Okay. Other than that, you will have the less, okay, combine with this into it. Cash flow, money in faster. So then what you can use, can use for other purpose. Okay, this is one of it. Okay, now next is that this one, when it's irrecoverable debt is reduced, it will also administration cost reduce. Okay, disadvantages is we can say when we want to encourage people pay faster, most of the time we have to give to encourage people pay faster, then we need to give the cash discount to encourage them. So when we give the cash discount, this is the expenses to business. Then our profit reduce. That is one of the problems that we have. And other than that, you want to have control, tight control on the credit control policy. That means you have to hire a staff to handle credit control section. So when you hire people, then you have to incur staff costs. So this also will affect the profit. And if you too strict, then customer some customer may stop buying and go to buy from other competitor. Okay, that is a problem you may have. But conclusion or recommendation, what do you think that you should do in order to encourage or not to encourage? Most of the time, nowadays, because people have worried customer cannot pay, they would rather not to do the business. So for me personally, I will advise Nazim to implement the strict credit control policy where 30-day credit term is reasonable to customer. Because basically 30 days to get people to pay you, that is a reasonable period. It's not considered very strict. So that will also help. Okay, it helps Nazim to reduce irrecoverable debt, risk, and improve his cash flow. So that is a recommendation that I put in. I say I agree. He implement the strict credit control 30 days because it's a reasonable. So that is for the question number 5. Okay, we end here.